Well, good afternoon to all of you, and I don't know about you, but I'm really excited because we have a fantastic panel to talk about a topic that is not necessarily the round-of-the-mill topic, digital payment, digital transactions, and we have a group of extraordinary panelists, and they each agreed to a particular game, which is that they have been assigned a role that resembles actually what they do in life. So, to my left is Benoît Queret. Benoît, very well known in this institution, is going to play the role of the supervisor. He happens to be extremely familiar with the issues that we will talk about today, which will make it far more interesting. But he will play the supervisor. Sarah is going to play the role of the incumbent. Now I'm going to say exactly what is the position of Sarah so that I don't make any mistakes. Sarah Youngwood is the Chief Financial Officer of Consumer and Community Banking at JP Morgan Chase. Next to Sarah, Sarah is the incumbent. Next to Sarah is an interesting character. He's the disruptor. Jeremy Allaire is the co-founder and CEO of Circle, an innovative crypto finance company based in Boston, which offers products and platforms to invest in and exchange crypto assets and to make payments anytime, anywhere, at very low cost, without going through intermediaries. He's not a Bitcoin man, right? And to his left is somebody who is wearing two hats. Patrick Njoroge is the governor of the Central Bank of Kenya, and he plays a double role because he's a central bank governor with first-hand experience regulating one of the most emblematic digital currency providers, M-Pesa. On the other hand, Patrick can actually speak of disruption and innovation along with Jeremy because he's been through that. And Kenya has managed to leapfrog many of the sequences that advanced economies are currently considering. So this is the panel that we have today in front of us. I would like to just take advantage of this moment to give a few, I think, principles on which we all agree. Any of those who are not interested over there who are making too much noise, please go away. So, first thing on which we will probably all agree is that cash usage is decreasing in many places. If you look at Sweden, for instance, only 13%, 1/3, of transactions are settled in cash. Second principle, which I think we will agree on, prevalent use of smartphones has spurred the growth of digital currency, often exchanged without the intermediary of banks. Don't think about bitcoins here. Think about Alipay, WeChat Pay in China, for instance, which is used to purchase fruit and vegetable on the street. Actually, in China, mobile payment transactions reached $18.7 trillion. That's the depth of that market. Third principle on which I think we can agree on as well, new technological developments such as DLT, distributed ledger technologies. And by the way, all panel members are going to refrain from using too jargonic abbreviations so that we can all understand what they're talking about. So these developments are allowing peer-to-peer payment platforms to emerge. For instance, in October 2018, a study by the Depository Trust and Clearing Corporation showed that DLT should be capable of supporting daily trading volumes in the US equity market of over 100 million trades per day. Now, against this background, clearly, the role of banks as providers of payment services is being challenged, and banks are going to have to adapt to survive or possibly disappear. One fact that I'm sure Sarah will be commenting upon, JP Morgan Chase launched JPM, but we all know what it is, JP Morgan Coin, a digital token that will be used to instantly settle transactions between clients of its wholesale payments business. That's where the disruptor is actually playing a role, because had it not been for the disruptor, the incumbent might not have had to do that. Now, central banks are also going to be in a tough place, because they're going to have to decide what they do. Cash, no cash? Central bank digital currency or not? Maybe. We know already that there are about 6 central banks that are looking at setting up central bank digital currencies. And in November 2018, a few months ago, the ECB, where Benoit is the head of anything having to do with digital and many other things, the ECB launched something called Target Instant Payment Settlements, TIPS. Anybody from Europe has heard about that? Okay, 3 or 4. Those from Europe here, ask your banks whether they know about TIPS. It is a surprise they haven't told you. They haven't told me. Because it's helpful. It settles payments instantaneously at hardly any cost within the euro area. More on that from Benoit, but it's fascinating. So, I'm going to turn to you, Jeremy, first.
Great.
You are my disruptor in chief. How do you explain the rapid adoption of all these digital currencies to make payments using mobile devices, particularly mobile telephones? And what is it that they offer which the banks were not offering?
Sure. I mean, I think if you make a distinction between, say, the sort of centralized mobile payment schemes, which would be like the Alipay or WeChat Pay or others, and then the kind of the emerging decentralized digital currencies, both are growing very fast. I think at the core, though, I think it's just this recognition that money is just a form of data, and the movement of money is just the synchronization of that data across institutions. And so, in a software-based world where you have the convenience of software on a device, and you have the ability to execute all of those synchronizations in a really efficient way, it's just going to be a radically superior method of settlement. And so, the centralized platforms have grown the fastest first, whether it be something like an M-Pesa in a country level, or it be independent platforms in the US like Venmo or Square Cash or Circle Pay, or in China, obviously the most noteworthy examples. Those have grown tremendously just because they're simpler and more convenient, and the operators can offer to businesses as well the ability to actually collect payments less expensively. Now, I think the growth in decentralized digital currencies is a completely other matter, and that's obviously growing very organically without any kind of centralized players involved. But I think it really just reflects the impulse that users of the internet have to want to be able to connect to each other directly and to interact, whether it's sharing a photo, sharing an email, sharing content, communicating. If they have the ability to directly interact and transact with value, that's extremely compelling, and it's extremely compelling for a lot of people around the world. And so I think that's part of what's grown that. There are other macro factors as well, I think, that have encouraged the development of digital currency.
Do you think that, based on what you said, there can be very strong competition vis-a-vis the banks, the incumbents?
I mean, at the end of the day, I think you have two big categories here. You have central bank money, which is issued by a sovereign, and it's the credit risk of the sovereign, and certainly that will continue to exist for quite some time. There are obviously weaker sovereigns than others, and so people value sovereign money differently, right? You can all look at the real world examples of reserve currency status and the like. So that will continue to exist, clearly. And I think the interesting thing from our perspective is, how do you take sovereign money and central bank money and tokenize it and actually turn it into a cryptocurrency that gets all the benefits of cryptocurrency, which is the reach of the internet, the scale of the internet, the speed of the internet, the security, the cost efficiency, and have a radically more open model for how value can move around in the global economy, but still have that be underlying based on certainly at least the major reserve currencies. There's non-sovereign digital currency as well, which we could talk about.
Okay. Patrick, you have the benefit of insight, and you are the central bank governor of the Central Bank of Kenya. Kenya has a sovereign currency, yet since 2007, when it was launched, M-Pesa has just penetrated the markets at light speed. What explains it? Kenya is a sovereign country, has a currency. Why M-Pesa?
Yeah, the M-Pesa was a success for several reasons. One is because there was a compelling need by customers, really by the population, to make transactions.
So there was a demand.
There was a demand for that. So it was filling a gap that was there in terms of transferring, let's say, making payments, P2P payments, from, let's say, people that work in the cities to the other people back home. That was important. But underlying all this, of course, is also technology. There was the technology to support it. And here, the mobile phone technology, for that matter, was the penetration rates were actually quite high at the time. Today, actually, the penetration rate is over 100% in Kenya.
Over 100%?
Over 100%. We are at 105. We just broke 100 a few months ago. So it just means that some of us have 2 SIM cards. That's basically how we get to 100. But the point is still penetration rates are very high in terms of mobile use of mobile devices. Thirdly, the regulator, in this case the central bank, was willing to experiment with this new product that was brought, M-Pesa, meaning instead of throttling the innovation, they also saw that it was beneficial and actually worked with the entrepreneur, with the innovator, to minimize the risk. So in effect, it was there was a test and learn approach, meaning they just put it on a pilot project, basically.
So I'm assuming that the telecommunication company was heavily involved in the process because the backbone of technology was provided by telecom.
That is correct. Actually, the innovator was a telco, was a telephone company.
And did you, as central bank governor, do you supervise them? Do you have a role to play as far as they're concerned?
That is correct. When this product was launched, and there has been other products, there wasn't a law under which this innovation would be regulated. So in effect, we regulated it as an exception, right? But then in 2013, we did put together laws which are passed by Parliament and regulations, under which now today we supervise them. So every year we do license them, and we have
every year. So you check against the conditions for the license every year.
So every year we have to, and we actually have to send a license to them in the old-fashioned way. So
right. I can't resist asking you one thing, Patrick. Can you tell us the story of how much you learn from the data and from the data points that are left by transactions that are happening as far as borrowers are concerned?
Oh, yes.
The woman and the market.
Yeah, yes, there's a story about the...
It's fascinating.
The story here is we now have a platform. And we were looking at this information on one of our key lending platforms. And we discovered that a lot of the transactions, more than about 40% of the transactions, take place between 3 o'clock and 5 o'clock in the morning. And we began to explore this and also discover that about more than 50% of the people that were borrowing were women. So there was a problem here. Are women insomniacs, in Kenya? We wanted to investigate this. But anyway, upon further investigation, we discovered what was going on. Basically, you have traders that are operating in the various markets. And these are, they are purchasing in the markets, and they are going to sell in the street corners and in the kiosks, those sort of things. So they wake up at 3 o'clock in the morning and borrow from this lending platform.
On their cell phone?
On their cell phone. They're still in their houses. It's all done on the cell phone. They borrow, and they'll get the money. They'll then call the the wholesaler, their trusted wholesaler, and ask for bags of this and the other, and pay by through their cell phone. They'll then call the person who moves this thing, and will then instruct them to go deliver at the kiosk. Then she'll go back, she'll now wake the kids, feed them, send them to school. And at 6:30, she is at the kiosk with all the products ready to sell and beginning a day. I haven't even left my bed at 6:30 as the governor. And this woman has done all these transactions. So, and in a sense, you can see the benefit of, it wasn't just the transactions, you can see the social benefit of such a simple product.
Now, Sarah, I'm assuming that you will not be competing with M-Pesa on that particular segment of the market. But what is competition for you? And tell us a bit more about JPM Coin and how you are addressing this, the challenge by the disruptors.
Yeah, I think what's very important is we love competition. And competition makes us better. And as long as we are solving problems for customers that solve an issue, we believe that makes sense. And so in the case of what Patrick discussed, actually, there was a void, and that void got filled, and then that void got regulated, which makes a lot of sense. From our point of view, we're in the US, a very mature market where there is 22% of cash still, but that's much less than, for example, China, where you have about twice that. Yeah. You have a very mature infrastructure at the point of sale, which didn't exist, for example, in China and other places. And therefore, you have the credit cards and the debit cards, which together represent 72% of the changes. And that, from the point of view of the customer, is valuable, is trusted, valuable because of the rewards, is trusted, and is immediate. And what we've done, though, is we have said, okay, Venmo, for example, let's compete with it. So as an industry, we launched a consortium amongst banks. And in fact, we are twice as big as Venmo. So Venmo would be about $65 billion, and this would be about twice as big. JP Morgan is just themselves bigger than Venmo. So actually the incumbent is using the exact same thing because social is important, because we need to actually provide that P2P, but we're doing with the security of the banking system. The JPM coin is something that we're doing on the wholesale side. So on the wholesale side, there is already the immediate payments, $300 billion, for example, on SWIFT GPI, which is how wholesale, $300 billion a day, and half of that is already happening in less than half of an hour. So that's already happening, and that's happening with 1,100 corridors, so that would be from one place to another in the world, and that's with hundreds of countries. So this is all happening, but what we decided to do is to say, okay, there is still a pain point, and it's the last mile, which is that to do KYC AML, and to do it correctly, sometimes the information stops.
KYC AML, know your customer, anti-money laundering.
Know your customer, and really making sure that the good actor and only the good actors can transact. And so we obviously need to do that, and we support doing it. When we do it, 50% of the time it checks green immediately and there is no problem. But there is also the case where we absolutely need to have a more efficient way to have the information move. So again, we went to technology, and the distributed ledger is actually a great technology for that, because we can put information on the ledger so that we can clear that this is a good actor and this is a good transaction immediately, instead of through phone calls, emails, and the old way the correspondent banks were trying to do that internationally. And so right now what we've done is we have separated the information network, IIN, from the movement of the currency on SWIFT, which is already working at scale at $300 billion. We are also doing an innovation of this JPM coin, where we're saying if we did them together, backed by US dollars, on the ledger, would that make sense? We are certainly open to doing it, but it's in addition to scale solutions that are already working in hundreds of billions of dollars.
Right, and when you say that you have actually, or you clear, I don't know whether you said that you track, but you clear the know your customer and anti-money laundering criteria or formalities on your system using the distributed ledger technology. Does that mean that you store those data and that then you reuse it, update it, or is it a data that you use once and is lost until the next transaction when you actually start all over again?
So
do you have history and do you keep record of that?
So the beauty of this ledger is the ledger is filled by over 200 banks. So JP Morgan innovated it, and 200 banks, international banks,
do you charge them for that?
I don't believe that we do.
It's a partnership.
It's a partnership, and it's for the benefit of everybody. Everybody wants to do KYC AML, everybody wants to do it well, and everybody wants information to flow better. Linear is never better than distributed. So using technology for that makes total sense, and it enables us to comply with what we believe to be the correct way to do it, which is transparently, safe, sound, KYC AML, but do it at a pace that satisfies customers. And we believe that that combined with the current global payment systems where there is already real-time payments in over 40 countries and working at scale, we believe that those two things together clear the problem that we're trying to solve as a community.
So do you think that if we were to refer to you some banks that operate in countries where correspondent banking relationships have been severed because of lack of compliance, of proper compliance with KYC and AML, then they could be brought into the partnership of the 200 banks, and then you could, through that system, facilitate the clearing of transactions?
Yeah, but to the extent that we only exclude people if we can't validate the validity of the transactions or of the source. And so to the extent that we can actually solve the information topic, it opens much more transactions. And we already have hundreds of banks that are in it because it's actually solving a problem that they believe is useful for them as well as useful for us.
But the initial screening and hard work of identification remains to be done. And it's just a lower cost, and over the course of time you amortize it, I suppose.
No, because actually, once you store it once, as you very well said, the information sits in the ledger in this very secure way. And so it's that tokenized information in the ledger that actually works. And so back to what Jeremy was saying, it's important to use the new technology and to tokenize the things that need to be tokenized so that it's safe, secure, distributed at the right time in the best way. We believe that that piece on the information is crucial and that it can be separated from the movement of money where the infrastructure is already provided.
So Jeremy with Circle is not a threat to you at all?
We believe that it has been wonderful to see the application of the ledger technology in many different ways. We are at a scale today when we're talking about $300 billion a day on the wholesale and at $75 billion a year approximately, or a little less than that, on the consumer P2P, 2 trillion for our customers, where it's working. And we welcome the competition as long as the activities of the competitors get regulated and as long as it's solving customer issues.
Benoit, you are in the supervisor role. So when you supervise these banks, they have to comply with all sorts of rules. They are subject to regulations, subject to various capital ratios and other ratios set out by regulators. What is their competitive advantage, and why would they not be better trusted by customers than those who do not have the luxury or the burden of supervision?
So I'm quite convinced that banks will stay, or are there to stay as financial intermediaries.
So is Jeremy, actually, not maybe for all currencies, but for the big ones.
No, they're all to stay because we need an ecosystem and we need competition, right?
So it's the spur of competition and the spur of innovation that will help us, all of us, work better and reap the benefits of all this innovation. And that's why we need a diverse ecosystem. Before going into the depths of that discussion, I wanted to thank you very much for having that discussion here. It's such an important and exciting part of the discussion on finance, because it speaks to all of us, it speaks to all citizens. It is important from a systemic standpoint, but it's also a discussion that speaks to all citizens.
And young people in particular.
And to young people. So that's one of the few areas in financial regulation where we have a direct impact, for the worst or for the best. And it's one of the few discussions we're having which is both exciting and important. I mean, as a central banker, I've got lots of issues which are very important, but really not exciting. A few discussions are exciting, but not so important, and that's one discussion which is very exciting and very important. So thank you very much. And when you think of what we can do as central banks, and I'm coming to your question on banks, there are three things we can do as public authorities, and more specifically as central banks. It's our duty to ensure that whatever organization, whatever ecosystem emerges from that discussion will be safe for customers, and will be safe as a system, and will be efficient, and will be trusted. We're talking about money, be it public money, or central bank money, or private money. Money has to be trusted. And it's really our role in that discussion to make sure that whatever emerges will be trusted. That's a duty we have to society. That's the first thing. Second thing is to provide some elements of the infrastructure that are better provided by us, that are, let's say, the backbones of the system. So we do real-time gross settlement, for instance, that has been the backbone of the system. We now do TIPS, which you mentioned, which is instant payments for the whole of Europe.
And for any consumer, anybody having...
Anyone can access it either through the banks or indirectly. And there are already talks of, for instance, in the UK, which has a similar system. The system can be extended to non-banks. So that's certainly very much part of the discussion, whether and when it should be extended to non-banks. And think about the cost. Think about the cost. We charge, as ECB, we charge 0.2 cents per transaction, which is €1 makes for 500 transactions, which helps understand why some banks don't want to talk about it.
I'm going to interrupt you for a microsecond. Mr. Disruptor, what do you think of that? 0.2 cents of a euro for any transaction?
Yeah, I mean, our thesis is that when you move fiat money onto public blockchain networks that have real scalability characteristics, that effectively payments will go to zero. That there will be no business model for payments. There'll be no consumer will ever pay for anything with payments. Merchants will not pay for payments. B2B transactions, international transactions, it will go to zero, just like sharing information on the internet and data is zero, sharing emails zero. It's effectively just
but the ECB is on its way to zero.
I think that's a good improvement, but I think zero is better.
Can I comment?
We won't go
a microsecond and then back to Benoit.
We won't go below zero. You can be sure of that.
But you might be tearing. No, sorry.
Zelle, which is this P2P payment, is free, and there is absolutely zero cost to transfer it back on your bank account because it is on your bank account. And so basically,
and that's
you have
within the United States.
Yes.
Right.
Right. So why are we doing that? And I'm coming back to banks.
Yeah.
We're not doing that to be tough on banks. We're doing that to help banks develop new services that they can deliver to the customers. And we know that banks are being disrupted. They are being disrupted in a sense from below by all kind of disruptors, startups, non-banks, providing payment services, and they're also being disrupted from the top, if I may say so, by big tech, these very big corporates who want to provide payment services in their own environment, like
like Alipay and all those guys.
Not giving names here, but you can imagine. And these are challenges both from above and from below. We are not in the business of helping banks. That's not what we do as central banks. Sometimes I would really like that some European bank CEOs would spend more time on dealing with their business models and how to integrate that kind of innovation in their business models, rather than complaining against negative rates, say, or complaining against regulation. And by the way, the best of them are doing it, and that's what makes them good, that they are doing it. they spend a lot of time adapting their business models to cope with that kind of disruption. But of course, there is risk in any disruption. And that's also part of our job to monitor the risks. So we're not there to steer the system towards one particular business model. And so whoever wins that race will be welcome. And we're very much in favor of competition. And by the way, the regulatory framework we're having in Europe is with a combination of, sorry for the letters, PSD2, which is a new directive on payments, Payment Services
Right.
Directive, which gives access to bank accounts to non-bank service providers who can build aggregators, provide new services, etc., having access to client data if the clients are okay.
Bank CEOs complain massively about that because
Well,
they feel
course.
that it's a free lunch for non-banks to.
It's not a free lunch. It's disruptive innovation, which has to be safe. We're working a lot
Okay.
on that,
All right.
which is there to challenge the system, which eventually is good for everyone. It's good for the customer. And that is combined with the GDPR, so the Data Privacy Directive,
Yeah.
which is a lot about protection, but it's also a lot about empowering the customer.
Yeah.
Giving the customers the possibility to transfer data from one bank to another, that's something that empowers the customer for the benefit of competition. So that's ultimately also good for innovation, good for the system. But of course, there are risks. So we are very mindful of these risks. And for instance, we want to be sure that we keep the right mix between public money and private money. And there is room for both. Already today, there is a lot of private money. Most of the money in the system is being created by banks.
Yeah.
So it is commercial money. It's what 90% of money is being created by banks. And that will stay in the future. But we want some services to be very safe. So for instance, settlement money in large financial market infrastructures will probably have to remain central bank money because that's about the stability of the system. But the mix could change in the future. So that we have to monitor very closely. And it's also important when it comes to our own activities. So you mentioned the demise of cash in some countries. There are countries where the use of cash is collapsing.
Yeah.
There are countries where it is increasing. So for most of the Eurozone, for instance, the use of cash is increasing.
Really?
That's not an issue we're facing. But we know that some countries are facing it, and it might come in the future. So we have to prepare for that.
Okay.
But then, so we might have to be prepared for a future where there will be a lot more digital money, including central bank digital money, maybe together with physical cash, or maybe substituting for physical cash. But what will be very important for us is that we want the system to be stable. And at the BIS, at the Bank for International Settlements, we are putting our heads together and supported by Agustin Carstens. We are spending a lot of time to also to think about what the risks that could be created to the system. Imagine that you have 100% digital money on a wallet, a central bank wallet. That's possible. It's technically possible. What happens if you have?
I think Switzerland was considering it for a moment.
So.
Never mind.
Yeah, I mean, there have been experiments. Uruguay had a very interesting experiment, the e-peso, which worked quite well. So we can learn from that. But the point I'm making is, if we are heading toward that kind of environment, then it will make it much easier for customers to take their money out of banks and put it on their wallet, right? It's just a click on your mobile phone. So it may make runs on banks more easier and faster. And that's an issue of financial stability. And so we need to think harder with you, with the fund, with the BIS, about the kind of world this would be and how to make it safer.
Yeah. You used the words repeatedly, which I think is really important, and I'd like you, Jeremy, and you, Patrick, to react to that. Trust.
Trust.
Jeremy, why do customers eventually trust Circle?
Sure. It's not so much about trusting Circle. It's about trusting the internet. And so, I think a really important thing here is to sort of step back. And I think we all live in this world now where we trust that we can instantly access all the world's knowledge within seconds, instantly. There's no corporation that runs the internet. There's no centralized company that controls who can put content on and off that network. We all value the freedom of being able to connect, transmit information, connect to other people in this very open global system. We trust the incredible utility of that open network, and we rely on that greatly. Now, there are companies that build services and value on top of it, of course, but fundamentally, that open network, it delivers just an incredible amount of utility value for people, and that's what they ultimately trust. They trust things that do more for them. And I think in this realm of money, we're looking at a very similar situation. It's hard for people to grasp a world where they could, first of all, control their own assets rather than have to entirely rely on an intermediary like a bank, and where they can transact with any other person on the planet instantly with zero counterparty risk, and they can do that at virtually no cost. I think people, if they experience that, they wouldn't want to go back from that world. And likewise, so it's trust in the network. We trust the World Wide Web. We trust internet email. We trust messaging. No government controls those. No corporation controls those. Those are decentralized networks of open source technologies that creative engineers are building and implementing and scaling. And we all trust in that public infrastructure. And that's what we're interested in with the future of digital money. We'd like to see public infrastructure that everyone can equally plug into from any corner of the world with any device and transact. That's transacting for a transaction in a market, or it's transacting as part of a supply chain, et cetera. The classic centralized clearing and settlement systems, whether they're administered by a central bank or administered in a public-private system or entirely by a centralized commercial operator, we think will go the way that those things have gone in the world of media and communications and retail. We will see much more decentralized systems, actors being able to participate directly, and consumers and businesses are not going to want to look back because it's going to be a radically superior set of utility for them and deeper economic integration than they had before. So I think it's hard for people to see past the status quo of, the ECB runs the payment systems of the Eurozone, and JP Morgan kind of does JP Morgan coin and US dollar networks, and those are incredible and significant and powerful systems. But an open internet model, I think, will ultimately be felt by the end users as a superior model, and that's what people are going to trust.
So that would be a step later. Do you see sort of a fragmentation of networks and sometimes regional operations that would eventually move up to a wider
Sure. I mean, there
network?
have to be standards, right? So the World Wide Web doesn't exist in a vacuum. There's a standards body, the World Wide Web Consortium. It defines the technology. It makes it all work. Lots of brilliant computer scientists, industry members, even government, academics contribute to that. It's a pool of open intellectual property. So we need the equivalent in this space as well. And so that needs government supervisors, that needs commercial banks, that needs technology companies. It needs a lot of collaboration there. But the end goal needs to look more like the open internet than certainly what we have today.
But so it would be the governance of a public good that is available to all.
That's right. And in our view, that ultimately, because digital currencies are inherently global, they exist anywhere the internet exists instantly. I mean, it's sort of uncontrollable unless you're a regime that wants to have a extremely strict, lockdown internet, which maybe there'll be more of, depending on the way things go politically. But I think, that is just, it's inherently global, and that will certainly create challenges for countries that don't have reserve currency status, because everyone's going to want to use reserve currencies, and they're all going to have access to them instantly at zero cost. So if I'm in Argentina, I'm going to want to use US dollar coin, and I'm going to want to carry that around, and no one will be able to stop me, very likely. And so that will create, I think, challenges for governments, ultimately in their treasuries as well. But those are longer term challenges. But I think that is very clearly where it's headed. And even what we see in the recent news this week, Facebook raising billions of dollars to launch a basket global digital reserve currency that is a stable coin that can be used by billions of people around the world to transact directly over the internet. We're not talking about like far off science fiction, we're talking about later this year. So I think these are the things that are coming faster than people realize, and they're happening by technology companies and by open source communities, not necessarily from central banks and large commercial banks.
Interesting. So it's digital SDR coming
I think
up.
that's right. I think that's technically possible and functional in the world in the next 12 to 24 months.
Fascinating.
Yeah.
Patrick, on the issue of trust.
Yeah, trust. I think at the end of it, the central banks, the only reason they operate is really because of trust, meaning credibility. So if we are not credible as central banks, we are done. I mean, we are out of the business. And for me, the model that Benoit was talking about, and he says there are different models, it all depends on which model is more trustworthy, meaning where do you have the bulk of, let's say, the population trusting that model versus another. So I don't see it more as a technology sort of issue. It's really about how much trust we have on a particular model that comes forward. In that regard, I mean, from our perspective, there are maybe 3 directions of trust. One is the technology, that you trust that the transaction will take place. That, and you know, we do that each time I call somebody on the phone. There's that technological issue. Secondly, you also have other, I mean, particularly concerning money, you don't want there to be some sort of fraud in it. I mean, it's one thing to look at something in the internet and it works, but it's another thing to lose half your money in the transaction. So that raises an issue of trust. And last of all, I think, is sort of the extreme situations. Say, for instance, as happens, the power goes down in a particular city, and you need to still transact. And that's happened. We have had problems around the world where the ATM systems go down. So what may have been a brilliant sort of solution in a particular state of nature, which is there is electricity and all these other backups, these things go down. So I think the trust element has to be not just by 99% of the population, it has to be virtually 100% of the population. And that's why, in my view, this sort of old-fashioned currency has sticking power because of the trust element, particularly in the extreme cases. Now, we could think of it also in poor countries where you have more or less literacy. You know, if you think of the percent of population that are literate. But I think it isn't just about literacy. It's really about trust.
Okay. Speaking of trust, how do you deal with the privacy of data? I know that the European Union has gone further than probably everybody else at the moment with the GDPR, the data privacy protection. Is it an issue for you? And how do you approach it? Because customers, precisely because of the trust that they put in you, expect you to treat their data with utmost respect and expect you not to sell it, not to transfer it, not to make unauthorized use of it. So how do you deal with it?
Yeah, so trust is extraordinarily important to us. Globally, actually, financial institutions are the most trusted group of institutions, more than governments, more than NGOs, and 6 times more than tech companies for the US. So the reason why they do is because we actually invest tremendous amounts in that trust, in protecting the data in cyber. We believe cyber is probably the biggest risk that needs to be addressed. I talked a lot about this KYC-AML, sorry, I'm still using the acronym, and all of those steps that we come and take are done for the benefit of the system so that the system is trustworthy. And it is worth some time having a delay if it is for the good, and of course we try to remove the delay using the latest technologies. And so there is nothing more important than trust. And the other thing that generates trust is the combination of human and technology. So for example, in the same Edelman study, they said that 2/3 of markets would have people interviewed that would say that it's more important to have a human than to have the best technology. I actually, and those 2/3 of markets, by the way, includes all the developed markets on the map of the world. Why is that? It's because at this point you have the technology when you go within the system of trust, which is the system of financial banks. $260 billion in technology spent within the banking system. So banks are technology companies. They just happen to be technology companies that uphold transparency, regulation, checks, balance, and combine it with physical to generate the trust.
Benoit?
Just maybe one additional thought on data from a regulatory perspective. that for sure big data creates fantastic opportunities, not only economically, which is quite obvious, but also for the customers if the regulatory framework empowers the customers to keep control of their data, which we don't have everywhere yet. So it creates opportunities for us as policymakers. It will help all of us do policy better using big data. But it creates a very substantial regulatory challenge, which is that we'll have to connect the dots across different regulatory domains. All that discussion that we're having here points to the need for financial regulators to talk to competition authorities, to talk to data privacy authorities, maybe at some point also to talk to intelligence services and the security community, which is a different discussion, which we're not used to do. We are used to do regulation in our backyard in a very comfortable way. So if we want this to work, we'll have to leave our comfort zone and to engage with other regulators in a way that makes the system work. And that's, I see it really as a challenge. I would expect the data issues to become extremely prominent, maybe the most prominent issue in financial regulation for the next 5 or 10 years.
Interesting.
Can I add something too? On the trust topic? I think it's really important is, we in the digital currency world, we have the phrase, in crypto we trust. Which,
what do you say, in crypto we trust?
In crypto we trust, but this is really important because all of this is built on this idea that cryptographic proof is a dramatically better way for society to organize around important information. And that rather than relying on fallible humans or corruptible intermediaries, that if we can rely on cryptographic proof, which is effectively saying we believe in math, and we believe in the ability to prove things with mathematics. That's all that this is. All this infrastructure is effectively mathematical proofs and infallible mathematical proofs. It's actually key. In fact, all of our infrastructure, all of our weapon systems, everything it's all cryptography. It protects us. But if we can, trust cryptographic proof, we can actually build radically more private, resilient, secure, and self-sovereign forms of financial transactions. This is really powerful. It's a core part of this decentralization movement, which is we have seen what happens when you have very powerful centralized intermediaries involved in your private data. We've seen that on a very massive scale in certain business models on the internet. We've seen the risks of that with data breaches from large financial institutions, government agencies. And so crypto and blockchains is not just about digital payments, it's about a fundamental new infrastructure for record keeping of important information and providing a dramatically more decentralized, resilient, and private infrastructure to do that, addressing huge issues that have emerged in the first generation of the internet. So this isn't, from my perspective, just about do we trust digital currency or cryptocurrency? Yeah. This is about really fundamental redesign of the basics of how civic society will ultimately function.
But Jeremy, Sarah was talking about cyber and cyber threats and the issue about security. Don't we have similar potential threats applying to? Well,
this is the yes and no. I mean, yes. a non-sovereign digital currency that runs on a decentralized infrastructure, the specific attack vector that they're trying to deal with is nation-state attacks. So basically, how do you build a currency that is resilient from malicious attack by a nation-state? I would say that that's a higher bar of security than, say, can your credit card get hacked, or is my IT firewall strong enough? This is essentially nation-state grade, resistance and resilience. That's the security bar of cryptocurrency. That's a radically higher bar of security than any of our existing financial system even has.
And that's where you echo what Benoit was saying, which is that it requires the bringing together of different skill set of different industries, probably, and public and private players playing together.
Absolutely.
Right.
Well, one thing I would add to this is my problem with this sort of discussion is really, it's fine to protect ourselves from outsiders, but I find it very hard to contemplate a world where we are also safe from insiders, because it may very well be that the greatest enemy is not a national state. It's really the CEO or the IT person in a particular cryptocurrency world. So I have a lot of trouble squaring that circle.
Well, that's the key. That's why we want to have decentralized currencies and networks, is that so you don't have a fallible human who can actually undertake that, and where the actual validity of the transactions and the validity of the state of the ledger is actually provable with math, not an information request to a bureaucrat.
But how do you reconcile that with what Sarah was saying, which is that people actually want human beings, they want contact. If you tell them to contact math, it's not going to be good.
And there has been more fraud in the Bitcoins than in literally any other form of payments that has existed. And so it is, I mean, there is cash and then there is Bitcoins in terms of the amounts of frauds.
Yeah, but we said we're not Bitcoins here on that podium, right?
Well, I think crypto assets are bearer instruments, and they're digital bearer instruments. We haven't had that before. We now have digital bearer instruments. It's really a powerful thing. And so bearer instruments are really attractive to people who want to steal things. And so what it suggests to me is not so much that there's a problem with it. Like we're going to use private keys, which are the technology for this, to secure everything. It just means that we need a different set of security standards around how we protect those kinds of assets.
Right, Benoit?
I think it's worthwhile introducing a difference in that discussion between fraud and systemic fragility.
Yeah, sure.
Fraud is forever. There will always be fraud. We've worked quite a lot in my committee in Basel, in the Committee on Payments and Market Infrastructures, on fraud on endpoint payments, which was motivated by a very famous incident with one central bank some years ago, and with the money, vanishing somewhere.
Yeah.
And
in some casinos. Far out.
Well, okay. I'm stopping here.
Yes.
And we certainly don't want that to happen again. When you look into fraud techniques in endpoint payments, it's not very sophisticated. It's a lot of abuse of identity, weak identification, and the like, which has nothing to do with technology. It is there. It can be mitigated by technology, but there will always be fraud, which we have to fight, but it's not really new. What can be new and quite a concern for us is the fragility that decentralization can introduce in the system, if not properly managed. So I'm not against decentralization. Decentralization brings benefits, also because the underlying technology does bring benefits, but we've got to manage it in a way that does not add to fragility. And I just want to offer one thought here. Remember 2007?
So very well.
Remember where we come from. We come from a crisis that was created by risks being thinly spread across the system, remember?
Yeah.
And which at the time was thought to be superior in terms of the robustness of the whole system.
And very well rated.
And it did not. It proved not to be. And we had to come back to a more centralized system in terms of regulation, stronger regulation, more data, more control, etc., to learn the lessons. So decentralization is fine. It's very fine from a technological standpoint, but we've got to make sure that it doesn't make the system more fragile.
I think the regulation that has been added since 2007 has been incredibly important to the safety and soundness of the system. And the fact that there is CCAR, which is a stress testing, the fact that there is resolution, which is you need to be able to show that in any scenario you can be dissolved and you can actually pay all of the people who come for their money. All of the players who participate in any future set of payments need to actually activity-based be regulated for those stresses so that the system is systematically safe and sound.
All right, we've heard keywords, but I would like to receive 2 key questions from the room. So one of you must have a burning question to ask all the panel members or one particular panel member. So you have 5 minutes, 2 questions. Come on. There are microphones that are right there, so please stand up. Your hand is up, your body follows, and you go to the mic. So and you introduce yourself, please.
My name is Dion Raboa, and I'm a reporter for Axios. My question is just about the divide that you talked about between China in particular using these digital payments and the US, and there's a lot of trust. Why is it that in China there's such trust in these technological new digital payments, and then as you talked about in Europe you're seeing actually now an increase of cash, and in the US we trust so much more in our credit cards? What is that regional difference that causes these striking dichotomies in terms of the way we're paying for things?
And don't forget Kenya, where clearly digital devices and transactions are heavily trusted as well.
Yeah.
I've spent a lot of time in, go ahead.
No, you go ahead.
I spent a lot of time in China and looking at these issues. I think my take is, effectively, hundreds of millions of people entered into the middle class, entered into the economic sector. They didn't have legacy infrastructure like card schemes. They didn't have even really much in the way of retail bank accounts usage. They didn't have laptops. They went straight to mobile devices, and the innovative software services that were delivered went into the hands of those hundreds of millions. And that was just a better platform. It is a better platform. It's a radically better platform than physical cards and payment terminals and all this kind of stuff. And so they took the cost out. They were able to scale it. And then, of course, given the network effects of a billion people who can communicate with each other through common applications, it just achieved a scale that has not been seen anywhere else. That's my high-level take on certainly what's happened with respect to China.
So not much baggage by way of previous instruments, previous channels.
Yeah, I mean, retail banks in China, if you're a Chinese person, it's a pretty miserable experience. But I think, WeChat and Alipay are delightful on every financial product that you'd want.
Yeah, I agree with you, and adding to that, the key element again is the problem that is being resolved. But at the same time, and by the way, we've tried to see how the M-Pesa success story could be replicated in other countries. And at times it's difficult to replicate it because the starting conditions are a little different and the problem isn't as apparent as it was in Kenya. But that said, I would also say the demonstration effect, meaning the other people that probably tell you, your neighbor, whoever else, that this is a very good solution for this particular problem. That was big in Kenya in terms of just the demonstration effect. Thirdly, there may be other services that are layered onto it. And I guess WeChat and others are good examples for this. And I think all three can drive to making a particular service much more prevalent in a particular jurisdiction as opposed to another.
Okay, I'm going to ask the last questions and then give you the floor each. Madam, you have the floor.
Thank you for the very interesting panel discussion. So I have two questions.
Can you say who you are?
I've been doing research and investment in digital assets for 3 years, and now I'm affiliating with ITU on a digital central bank digital currency project. And so what's your opinion about the role of the stable coin in the future? And do you think it's a compromised version of fiat and cryptocurrency? And the second question is, what's your opinion about the rising digital banks in Europe, such as N26? Thank you so much.
Can you repeat?
I got the first question.
Second question?
Do the first.
Okay, sorry.
And then the second.
What's your opinion about the role of stable coin?
Stable coins.
Yes.
Okay. And the second?
And the second is, what's your opinion about the rising digital banks in the EU, especially in Europe, such as N26, like
M26.
Yeah, so this,
M26, it
like
sounds like an
digital
intelligence
banks.
service.
what's that?
Yeah, I'll
Neobanks.
I'll take that.
You take those?
yeah.
Okay, perfect.
Okay, perfect. Thank you so much.
The Europeans at the table will take those.
Yeah, I'm the
Patrick.
European. Token European.
On the,
Let me take the second one. This is really banks that do not have, that are totally digital. So this is breaking the brick and mortar and really having just purely just electronic presence, nowhere else. And I think they will make an impact. And I think what has happened or what will happen is that there will be less and less of the brick and mortar because most of us, particularly the new generation, they all want their services now and wherever they are. So anywhere, anytime sort of services. And so the digital banks will have to rise. There'll be more of them, or at least compared to where we are today. The concern for me is not so much that they are digital or not. At the end of the day, they're still banks. So they need to be regulated, and we need to look at them like we would any other bank. So in terms of capital ratios, in terms of prudential, how we regulate them, it is exactly like any other bank. The only difference in my mind is the quality, is the type of staff that, and the people that operate it, meaning they are not exactly your typical CEO of a bank. They are much more tech literate and whatever goes with that. So I think the point here is that this is the new wave of having more and more digital presences or digital, let's say, front end, as opposed to just having your regular brick and mortar.
But you would regulate them if you were in charge.
Yes.
And as a result of that, they would be better trusted because they are under your regulation.
The only thing that we wouldn't be too concerned about is if they are just lending, credit only. They too need to be regulated, but they cannot be regulated the same way as banks are regulated. But for sure, if it is a bank, we will regulate it.
Okay. One word each. You have 30 seconds. I'll start with you.
So if I may come back to China,
yep.
I think that was a really important question because it points to the different social preferences on key drivers of our discussion, like the preference for cash. It's obviously very different. And I can tell you in my activities as ECB board member, I've faced very different approaches to cash across our constituencies. When we decided to stop producing the 500 euro banknote, that was a very controversial discussion, but for good reasons. Because history is different, because social preferences are different, because approaches to privacy are different, even across European countries, not to mention Europe and China, Europe and the US. So I think the bottom line here is that any new landscape that emerges from our discussion will be driven by market forces, obviously. Yep. That's what we're seeing here, yep. Market forces.
Supply, demand.
But also by different social preferences, and we've got to accept it. So in particular, when it comes to means of payment, we've got to let citizens choose the means of payment they want to use. And there will be different answers across countries.
Which leads you to believe that there will be competition, but there will continue to be competing mechanisms. It will not all be digital, it will not be all cash, it will be plenty of operators using different devices.
And it's important, and that question is important enough not to be left to we guys around this table, that is not to be left to the industry, even not to be left to central banks alone, because these are fundamental questions for our societies. So at the end, it is a political discussion.
Which brings private and public together as well. 30 seconds.
First of all, I'd like to say in China, it's only 22% wallets, 40% debit cards. So even there, there is the balance that you're talking about. We are for customer choice and for solving problems that need to be solved, and definitely activity-based regulation to ensure the safety and soundness of the system.
Okay. Jeremy?
Sure. I think, from my perspective, we're thinking about what happens when you have an open public infrastructure where not only can you exchange value instantly, anytime, directly with anyone, but where that infrastructure also allows you to write in code economic contracts and allows you to build economic relationships between people and businesses that are implemented in code, enforced by machines, and run over the public internet and run over this public infrastructure. That's the world we're moving into, and I think payments is actually the sideshow. Payments is going to disappear, just like we don't think about data exchange or other things. It's just in the background, it's invisible. The really interesting innovation is now that we have these public infrastructures like blockchains, how can we start to automate and integrate economic actors all around the world in much more innovative ways?
Patrick?
From my perspective, digital payments provide a specific service that we have yet to exploit. And I think the way I would see it is that it gives the consumers a certain footprint. So I'm not of the view that digital payments will wane going forward. On the contrary, we have yet to exploit the value of the information that is generated when you actually make a transaction. For instance, think of a big problem that we've had for many years, the SME problem. And an SME, well, SME, small, medium-sized enterprise. So you asked us not to use an acronym. So the small, medium-sized enterprise, which really, in most places, they are more than 90% of the production or 90% of the farms in Europe and even in Africa. The point is that today, it's just a production location, meaning they are just producing some specific items. But once you connect it with all the transactions that it's providing, you then begin to see that it is part of a certain community. And then you can provide it with credit, you can provide it with all the other services, because it's no longer just an isolated piece. And that you cannot get if you ignore the transaction, the information that the transaction is kicking up. Now, it's true, we talk about it in the context of artificial intelligence and all that, but really this is what will transform us going forward. So I am much more hopeful about the power of digital, the power of the transactions and digital payments, because we have yet to begin to scratch the surface.
Okay, you now allowed each 2 words in answer to my question. Tomorrow morning or later on today, you're going to have a cup of tea or a cup of coffee somewhere. How will you pay? 2 words.
Credit card.
Okay.
Still.
Credit card.
A user interface built on top of the credit card networks, but not a credit card itself.
2 words.
Patrick.
If here in the US, credit card, at home, in Kenya, M-Pesa.
M-Peso. All right. Okay. Round of applause.
Thank you. Thank you. Thank you.
That's it.
No.